bank lending risks jolt traders, raising stock market concerns. Earnings season has begun to peel back the glossy veneer that has long shielded the US equity market, revealing a fragile underbelly rooted in the lending practices of regional banks. Two mid-sized lenders, Zions Bancorp and Western Alliance Bancorp, announced on Thursday that they fell prey to fraudulent schemes tied to loans for funds that purchase distressed commercial mortgage assets. The fallout was immediate. Both stocks nosedived, dragging the KBW Bank Index into its steepest decline since the tariff-driven sell-off of April. The revelations have sparked a broader conversation among analysts, regulators, and investors about how deeply regional banks have entrenched themselves in high-risk, low-liquidity real estate financing. Unlike the diversified portfolios of major national banks, many smaller institutions still depend heavily on niche loan products that can amplify losses when the underlying property market wavers. This concentration risk has now been thrust into the spotlight, prompting a wave of caution across the trading floor of the New York Stock Exchange, where brokers were seen scrambling to hedge exposure and rebalance portfolios. Market sentiment has turned sour, with technology shares and other growth-oriented equities retreating as investors reassess the risk-reward calculus in an environment where credit quality is suddenly in question. The incident has also rekindled calls for tighter supervisory oversight, with lawmakers urging the Federal Reserve and the OCC to impose stricter capital buffers on regional banks that engage in complex, leveraged loan structures. As earnings reports roll out, every disclosure from a regional lender is being dissected for signs of similar vulnerabilities, creating a climate of heightened vigilance. Broader implication is clear. Even a handful of dubious loans can cascade through the financial system, destabilizing confidence and prompting a re-evaluation of risk across asset classes. With the macroeconomic backdrop already strained by inflationary pressures and geopolitical uncertainties, the market is likely to stay on edge, watching each new piece of data for clues about the health of the banking sector and its potential to trigger broader market turbulence.